There. Now, AR is your credit, so these are going to be your credits. Common stock, you got cash, and additional paid in capital. Now, we have $1 par value shares, so this is the balance of your common stock account, and it represents one shareholder for every dollar. So now you have 22,800 shareholders out there that purchase your stock, and they purchase it in excess of par, which is the $1. All right, so it's all important. So now we need to post this to the general ledger. So coming back over here, we're back in, we'll start at the top, cash. So cash is your very first account. You have 2001. These are cash receipts. And CR, cash receipts 1, in case you wonder where it came from, you can go back and find it. And we have a debit. It means the ending balance in that account is going to be the 408,290 so far. AR, now we've already had this, so this is good, because now we made a sale, and look, we want to see this, cash received. And the credit, it's a credit to the account, is given there. Now, what's important here is how much AR do we still have left to get, right? So it's the difference between your sales and your cash that you've already received. That's your ending balance of AR. Another way to think of this is like a long T account, or a different way of seeing the T account, right? Debit and credit. All right, so your common stock, 2001, cash received, CR1, cash receipts. It's a credit entry. Make sure you get on the right side, and of course run the total negative. Additional paid in capital, same thing. down here to this sum function, I can see 408,290, 408,290. I'm doing all right. All right, so now we just posted the cash receipts into the ledger, and we need to do the subsidiary accounts. So because we received cash from these people, and we need to go and say, all right, well, Joe, you don't owe us money anymore. So if we come to our subsidiary ledgers, all the way over here, we're going to start at the top. Joe paid. We're crediting AR in our scratch paper. That's a credit to AR, and here we'll also see it as a credit. Joe is 22360, and then I'm just gonna show the total, and then come down here and see if there's any other Joes, because what can happen is he paid us later in the year as well. So Joe in April. Looks like he's doing monthly payments. That's always nice to see. 13,975 has paid us any more. Oh, there it is. May 19. For all of your vendors, I don't want to bore you here as I walk through this. So let me see if I can do it quickly. All right, there's Joe. So go ahead and do this. I'm not going to show you myself doing this, but do this for Betty, do this for Joanne, and do this for Steve, and do this for Bob. All right, so go ahead and work on that, pull that all together, and then we will move on to of your project. We have our cash disbursements journal. I'm going to pull up this scratch paper again to show you what's going on in cash disbursements. Cash disbursements means we are paying cash. So our credit in this amount all the way down here, this is our credit cash. So what's our debits? Well, our debits are going to be up here. So we have accounts payable, gasoline, marketing. These are expenses: gas expense, marketing expense, utilities expense, rent expense, office supplies expense, prepaid insurance. So we paid an asset, prepaid insurance. And we have other. Now that other is defined down gasoline expense, these are all debits. are what we need to post. So credit here is going to be cash. If I did this right, this total of cash is going to equal this total, 262,411. All right, so now what we're trying to do here is we're trying to post this cash disbursements journal to the ledger. So we come to the top and we say, okay, here's our accounts payable. I'm going to go ahead and do cash, post cash. It's the first account here, I know where it is. So this is 2001. This is our cash paid. CD 1, cash disbursements year 1. The credit to cash is 262,411 for me. And that means my ending balance in cash before any adjustments or before we finalize financial statements is there. All right. And then I'm going to run and post all of these. So with AP, whenever you have an entry to AP or AR, you also have to deal with the subledger. Cash paid, or actually cash dispersed. Yeah, cash paid. I'll call it payments. A debit. So that means my ending balance. Now make sure your signs are right and what you want it to be. You need an ending credit in AP of the initial purchases less any payments. I'm going to stop right there. I have not posted these other ones yet, but whenever we hit that AP, I want to talk about the subsidiary ledgers. Okay, so here's my subsidiary ledger for AP. I got to come over here to my, I'm going to do it on this one, subledger, pull up my project to see who's paying, who I'm paying, and I have 2 vendors that I know I should be paying. So here's my project. Accounts payable, this is going to show you what you've paid. So we've paid Scott, we've paid Massive Building Supply in these different checks and payments. So, and here you can see the check number. But I'm going to start with Scott. So in 2001, this is going to be a payment, and it comes from the cash disbursement journal, and we're debiting AP, which means we need to debit the AP subledger, and it's going to be for 11,200. Now you can 220. You gotta watch those. And it looks like I did it right, 4 to Scott. So here I come down to my next payment to Scott, 16,830. My next payment to Scott here is 22,440. And then let's see, did I pay it off? Nope, that's it. I only made 3 payments to Scott, which means I owe him at the end of the year I still owe him $56.10. All right, let's go over to Massive Building Supply. It looks like I didn't fully complete this. Hopefully you did. We have a 2001 payment, cash disbursements, and for Massive, 8,880. Massive 11,100 and Massive 2220. So it looks like Massive we paid off and took it to 0 at the end of the year. So this is a good example because what we're going to do later on in the project is we're going to do a reconciliation of the AP subledgers to the AP control account, that main account. And this is an easy way to see it because we also need to do it for AR. we're going to list out, and that's actually one of your tabs if you remember that you created here, AP and AR subledger reconciliations. And so one of the things I can go ahead and start doing while I'm here, AR subledger reconciliation. I'm going to leave some space. I'm going to come back to that AP subledger reconciliation. So my AP subledger is going to be to Scott's. Who have I paid? Scott's, or done business with. Excellent Lumber and Massive Building Supply Store. So I go to my AP balance. Scott's ending balance, I can do it over here, it'll let me, in the subledger is 56. Now that came from me doing the purchases journal and the cash receipts journal, cash payments journal, cash disbursements journal. Then Massive is 0. And so this is going to be my total AP subledger. And what I want to do is make sure that my subledger matches my main account. AP account. If I go to my general ledger for AP, 5610. If it matches, they both get a double underline and we are good to go. If they don't match, then we have a problem and we need to go fix that. So this is a check for you. Same with AR. They're going to come when you're done working on all your subledgers. And you can do that now if you want. Pause this video and do that. You're going to list out Joe, Frank, Betty. You're going to list out all your customers. You're going to put their balances, and then you're going to have an AR account. And you're going to go and you're going to say, okay, all of my subledgers, now that I have all that activity, should equal my ending AR account, which is, at this point, 65,410. So you would expect all of your customers and a part of your grade for this. Okay, in this lecture we're going to pick back up with posting our cash disbursements journal to our ledger. So we've already done AP and we've already posted cash, the two highlighted here. Now we need to post all the other debits. So I've already done this so you can see what it looks like. But let's look, for instance, at gasoline expense and marketing expense. You're just going to put the year, right, that it was a purchase. Your reference is cash disbursement 1. This is the gasoline expense account. And then you have your debit there, and you're going to carry your total over there. Same with marketing expense, purchase, so forth. So go ahead and post all of your expense accounts. I will note that prepaid insurance is an asset account. So you're going to want to go find that in the asset accounts. And taxes payable is an interesting one. So this is essentially a prepayment on taxes. We have a debit to taxes payable, and that's where the account is going to be as we move forward through this this project. So we have a debit to taxes payable, and then we have a debit to dividends payable. So we've paid all of these things. So make sure you get all those posted, and then that will be the final journal to post. All right, now we need to start working on the adjustments worksheet. So and this is a big project. You come to the adjustments worksheet. We need to make sure it's set up in account order, and we have the formatting like this. Beginning balance has debits and credits, adjustments, debits and credits. You have your adjusted trial balance, income statements, and ending balance, which will ultimately go to your balance sheet. So you'll want to set this up here. Let me zoom in a little bit. One of the things that we need to do is we need to get all of these accounts in here. So I'm going to go ahead and freeze these panes. amounts come from? Well, all of these amounts are going to be pulled from the ledgers. So now that we've posted everything, we're ready to move forward and work on our adjustments. But let's get our worksheet set up. So cash, wherever cash is, before you do adjustments, after you get all your journals posted, you're going to go to the cash account. I'll arrange these. Go to the cash account. Page 1. And pull that number. And best thing to do is to cell reference. Grab your ending balance cash where it is. You're going to do that for all your accounts. Grab AR, shop, office, prepaid, AP. Watch your debits and credits, making sure accounts payable is a credit. Your taxes payable is a debit. We just talked about that. You have common stock, additional paid in capital. Everything needs to be pulled over. Sales is a credit. All your expenses are debits. Once you get all of that copied over, pulled straight from your ledger at this point in time, then to do a check, you're going to sum the column, right? Sum all those cells. Then we need to figure out our error before we can move on. Okay, so the next thing we need to work on is our adjustments. And before we do that though, as we look at this worksheet, let's get this set up such that it is computing automatically. So we need to insert an if-then formula in our debit balance and a different formula in our credit balance. So let's look at the debit balance. I'm in the adjusted trial balance, debit balance, and I'm on row 3. So that means all of my formula is going to have B3C3 because it's going to be doing row 3. All right. So here we go. I'm going to click on this so you can see what it's doing. Up here it should tell me, if I click within this formula, it tells me what's happening. So this is a logic test. It's saying if this, then that. So if B3 minus C3 plus D3 minus E3. So if this math returns a positive number, that is, you can see greater than 0. So that means it's going to end debit, right? If there's more debits, if it returns positive, then it's going to be a debit balance. And in my debit balance, I want you, if that's true, I want you to put that formula there. If that's false, so if it returns a negative balance, which that's actually a credit value, down and you'll be good to go. All right. The credit formula is similar in the logic test is if that math is greater than 0, meaning it's a positive number, then go ahead and put 0 there because I don't want my positive number. That means it's a debit balance and I'm putting that in the debit column. If it's false, meaning if that returned negative, then this, be careful here, this is a different problem or different calculation because we want it to be a positive number. So we're going to take C3 minus B3 plus E3 minus D3. This is essentially a T account representation of ending balance being credit or ending balance being debit. All right. So there we go. Once you get those formulas in, copy paste those, drag them down, and you'll be good to go. And you should have numbers equal to everything in these columns. You know you've done it right and you're ready to move forward. Okay, then you have, as we just scroll over, your income statement. Everything that is an income statement account needs to be in the income statement column. So you'll just, I did equals and I went and grabbed that adjusted trial balance. So a couple cells over, grab that sales number, and then same with all your expenses. Grab those. So I just said okay, sales, and then I dragged that formula down so that it pulled in all of these cells, and then same with the credit side. Balance sheet's going to be everything above it, same thing, pulling over all your debits and all your credits straight from the adjusted trial balance, but here only the balance sheet accounts, which is everything dividends declared and up gets reflected on the balance sheet. All right, let's start looking at our adjustments and make sure time, what are these adjustments about? So the first adjustment's telling me they went out and they counted all of their shop supplies on hand that they had in their shop closet or their warehouse. And there is 1,570 shop supplies on hand. That's the ending balance in the account. So we need to make the ending balance be 1,570. So if we come over here to the scratch paper, here I have the adjustments. Let me show my worksheet. Yeah, I thought I might have done too many. Let's see. All right, so my worksheet says where is my shop supplies account? Shop supplies on hand before any adjustments. It's sitting, I pulled straight from my worksheet, it's sitting at 22,200. In my problem, I was given that the ending balance in shop supplies is 1,570. So I just need to make an adjustment. The adjusting process is where was the account, what does it need to be, and then you make the adjustment. So we need to credit shop supplies. I'm going to put it over here in the credit shop supplies. And now the other side of this entry is going to be debit shop supplies expense. This is because we used up some of these shop supplies, so we're moving them out of the asset, credit the asset, and put them into the expense, debit the expense. So then, once I get the entry, my adjusting entry figured out, I'm going to come over here and make sure it's reflected in my columns here and that the math is working the way I want it to. So I need a credit to shop supplies on hand to reduce that. And whenever you make an entry, make sure you do the other side of the entry because these columns must balance. All right, so I'm in shop. So there we go. Okay, so I put this little check down here, the difference between the two, so I can see if it ever got out of balance, and I do not want it to get out of balance. That will make my balance sheet not balance. And so what I want us to also check then is once I put that in shop supplies, is my ending balance in shop supplies what I want it to be? Why, yes, it is. My adjusted trial balance is where my problem told me to take it. And then my expense account is also reflected appropriately. All right, I'm going to go ahead and stop there and we'll pick up with the adjustments in the next lecture. Okay, in this lecture we are going to finish our adjusting entries. I've started some of the work for us, but let's look at adjustment number 2, office supplies. So in your problem, you're given the ending balance of office supplies on hand. That means we went out and we counted and we determined that the amount of office supplies that have not been used up are 1,010. So that's an asset to us. So that means the ending balance in that account needs to be 1,010. Now we need to figure out where it was. So office supplies on hand has nothing in it. So we just make the adjustment. We need to increase the account for 1,010. So that's a debit to office supplies on hand. And then the other side of that entry is a credit to office supplies expense. And that's because we are reducing the expense since we took all of the cash. This 3,030, it came from the cash disbursements journal. We took everything to the expense account. We said we used it all. But in fact, when we went and we looked at our office supplies, we still had some remaining. So we need to reduce the expense and bring it down and increase the asset. All right, so that's adjustment number 2. Adjustment number 3 is very similar. Our ending balance of lumber inventory. So we have ending balances given. We need to look at where it was. The account is sitting at, on your worksheet, starting at 56,100. That means we need to bring the account down by 48,250. So we need a credit to lumber inventory of 48,250, and we need a debit to lumber expense. We're using up that lumber. So then that entry gets posted, credit lumber inventory, debit lumber expense, making sure you have equal debits and credits every time you do these entries and you don't throw your adjustments off balance. All right, we're going to go ahead and skip number 4. We're going to come right back to it. The 30% tax rate is the tax accrual, and we're going to do that at the very end once we get all of our expenses updated. So number 5, dividend per share is declared. So that means every single shareholder gets a 15-cent dividend. So where we start is we go to our dividend. Well, we have 22,800 shareholders. They each get a 15-cent dividend. So that means our total dividends that we're declaring at the end of the year, 15 cents per share, are $34.20. So we debit dividends declared, which means we're paying out some of our earnings. Dividends declared is a contra equity account, reduces earnings, and we owe money, dividends payable. So that's, we haven't paid them yet, but we're going to be paying them. So that's our debit and our credit, and we make sure it gets posted. I say posted, but really it means put in the adjustments column. All right, the last one for the tax accrual is insurance. Now this one is commonly missed, so let's take some time and look at this. We have a premium, which just means that we paid money to have an insurance policy. They call that a premium. So we paid money to have an insurance policy, and this information at the bottom of your cash disbursements journal tells you about this policy that you paid for. It is a business insurance policy, and it covers 18 months ended June 30th, 2002. So we made a payment in 2001 that relates to 2001 and 2002 insurance costs. Some of it needs to be in prepaid. The amount that needs to be in prepaid is the amount that relates to 2002. So there is 6 months, January through June of 2002, that needs to be sitting in prepaid. And the rest, which is 12 months to get to your 18 months, is expensed. So how we look at this is we say, okay, what's our premium, which is the total that we paid. And we can look at that, we can see that by looking in our prepaid insurance account and what that amount is. How many months is the policy? So this is our cost per month. We divide the premium divided by the policy months. And then we say, okay, we need 6 months in prepaid. So my ending balance in my prepaid insurance needs to be 6 months. That all relates to 2002. My prepaid insurance account started here. All right. Insurance expense is, nothing's in there yet. And I learned that my ending balance needs to be 12 months. So multiplying our per month by 12 months, and we get an adjusting entry of 24,840, and that updates both accounts appropriately. So that's our entry. We journalize it, debit insurance expense, credit prepaid, and then that gets posted into our worksheet. All right. The last entry is our tax accrual. I said we'd come back to that. That's because we needed all of our expense accounts updated appropriately in our income statement columns. So looking at these income statement columns, how we get tax expense is we have to figure out what are we taxed on? What is pre-tax income? So pre-tax income is sales and you multiply that pre-tax income times your tax rate. So you made money and you're excited, and the government's also excited that you made money because they get 30% of your earnings. Isn't the tax law nice? You get to keep 70% in retained earnings, which is actually net income, and the tax law, the IRS, says you have to give them 30%. So that's our tax expense. Tax expense is always an income statement number, and it can come from pre-tax income times your tax rate. So tax expense is 37,029, and in this problem we have no deferreds, which is a note I made right here. There are no deferreds in this problem. If there are deferreds, this entry will look very different. Taxes payable is not the same as tax expense because we aren't going to owe the same money to the government. So just something to remember as we go into 2002 and 2003 projects. And another really important thing is that this entry does not go on the adjustments worksheet. We don't put tax expense in here because it would create a circular problem of tax expense being included in pre-tax income, and then you'd multiply by the tax rate and you would get tax expense, and the math just doesn't work. So it does go on the worksheet, but it goes down below. It doesn't go in the adjustments columns. So the other side of that entry is taxes payable, and that's a new liability account over here. So our new liability entry. Taxes payable, though, does have some money sitting in it. If you'll remember, there's a debit of $12,600. Then that's the beginning balance. Then we just recorded this 37,029. So the ending balance in taxes payable is going to be a credit balance of 24,429. Now this is really important because this is the amount that goes on the balance sheet, the ending balance in that account. That's what we owe at the very end of the year to the IRS. We had a total liability of all of our activity of 37,029, but we already paid them prepayments on that of 12,600. So that creates an ending balance there. So this is really important, this tax accrual. We're going to visit it a lot more in the course, but hopefully this helps with the first year. All right, in the next lecture, I will walk through the financial statements. Okay, in this lecture, we're going to be pulling together our financial statements. So we're going to navigate to, I'm going to have the adjustments worksheet open, and I'm going to be looking at these far columns, which are kind of our ending part of the worksheet, as well as pull up my income statement. So I went ahead and started this. You'll need to make sure you have your headers and all your accounts listed, as well as the formatting here for it. We'll talk a little bit more about the formatting as we go along. But really pulling together the financial statement should be pretty simple, other maybe than taxes that we just briefly talked about. So that tax expense and taxes payable entry does come down here to get these balance sheets to balance. The other thing that you'll see down here in the worksheet is this net income. So anything that needs to go to equity that's not in there yet, right? We haven't touched retained earnings up here in our worksheet. And so that net income will get closed into and be captured in retained earnings. So that's showing that down here. And I can say net income to retained earnings. That's what's happening. So it's part of equity, and that will show our balance sheet columns balancing here at the end. All right, so let's pull together our income statement. Pulling from the income statement columns, we have sales, and then we have all of our expenses. Always cell reference. Don't hard type things in. It'll cause potential errors. All right, so there I just dragged my formula down because I knew I had these in the right order. And I can always double check it as I look at pre-tax income here. So pre-tax income is is sales minus the sum of my expenses. All right, and then that agrees out, so I know I got everything right. Tax expense, pre-tax income times your tax rate that's given, and then net income is pre-tax income minus tax expense. So that's what we get to keep. Earnings per share is an important calculation. It is net income divided by ending balance common stock. So we'll get our common stock number down here figured out, and we'll talk through that calculation. All right, another thing you'll notice here is formatting. So all these lines tell a story, right? This line, right, to compute pre-tax income means that this is a sum. This is computing. This is a calculation number. And similar to this line here, underneath the tax expense, like those lines mean something. Net income is double underlined, means we're done and it's agreed out and we're good with that number. And then you also notice your dollar signs. I like dollar signs at the top and the bottom, and we also need to know we're in US dollars, that's the currency that we're in. The other thing I'll say is formatting wise and presentation wise, as you write out these titles, be consistent in how you capitalize your words. So this has the first letter of the first word capitalized and the second one not, and that's just consistent. If you want to capitalize everything, that's fine, just be consistent is what I ask. And I do want you to make sure you're doing a thorough self-review before you submit the project. I don't want your first draft. I want it finalized, like you're turning it into your boss and it's your best work and you're proud of it. So make sure you spend that time, do a very, very thorough self-review. Have a second set of eyes on it if you need to, or wake up the next morning and look at it with fresh eyes, because you'll be surprised at some of the errors that just happen. Okay, so let's do our statement of equity. Beginning balance here is 0, and your totals is always going to be a sum. So I'm going to sum those and drag that down. Ending balance. So ending balance is going to come from my balance sheet over here in common stock. Now my panes are not frozen. Let me refreeze. Freeze panes. So I can make sure I pull over the right accounts here. All right, common stock 22,800. These are your ending balances in the account. Retained earnings, we don't know our number yet. Retained earnings is a function of net income. I'm going to pull down my net income and dividends declared. Dividends declared reduces retained earnings. We're going to pay those to our shareholders. And so the total is going to be the beginning balance plus net income less dividends declared. All right, and then a total over here will be a sum of all of these. And I'll drag down the sum as well. Okay, one of the things we need to make sure, and I caught it over here because I did this quick math. I was like, this doesn't equal 200,000 because it doesn't sum down. And that's because I didn't put my issuance of common stock in here, my issuance of stock. So how much stock you issued is going to be the difference between the ending balance and the beginning balance. Now it's hard to see here because that is the same. But next year when you issue more stock, you'll add that to the beginning balance. Ending balance this year is beginning balance next year. All right, and then my formatting got off. I don't want all these dollar signs over here, so I'm going to copy and paste that formatting. All right, so that is almost done with income statement and statement of equity. Net income, it's a quick calc divided by ending balance common stock. And you'll also note, I'm going to delete that for final purposes, I don't want any work or any additional noise on your final draft of your financial statements. I will say pennies. There's no pennies in any of these numbers except for earnings per share. It's the only one that we get to show pennies in. All right, let's look at the balance sheet. So your balance sheet is similar. We need to get it formatted appropriately and get all the accounts in there. And once you do that, then you can just pull over, other than taxes usually, everything just pulls right over. All right, and then total assets. Again, dollar signs at the top and the bottom for presentation purposes. All right, accounts payable. Taxes payable, if you'll remember, we need to go to the scratch paper and pull the ending balance from my RT account. That's our balance sheet number. Dividends payable. And total liabilities is a sum. And then the statement of equity over here that we did needs to tie directly to the balance sheet. So I'm going to pull all the amounts, ending balance common stock, ending balance additional paid in capital, ending retained earnings. These should all tie. One of the things in your grading rubric is that your balance sheet ties to your statement of equity and your equity ties to your balance sheet. All right, cross your fingers. Hope you did it right and you have a balancing balance sheet, and we do. So we are good to go. All right, so the next thing that we need to do is we need to journalize our adjustments in the general journal. So we did all the work here. Now we're going to copy those over to our general journal, page 1. Underneath the dividend entry that we made at the very beginning, we have our 2001 adjustments. So you should have 6 entries. We have 6 adjustments, and each of those is pulled straight from that scratch paper that we worked on. And once you journalize them, you then need to post them into their general ledger account. So for instance, you need to go to the shop supplies general ledger account. Each line needs to get posted and record that expense or post that expense to the appropriate account. All right, so here I have it posted, the shop supplies expense 2001 adjustments general journal, page 1. Pull that number over, give you a total. All right, so once you go through and journalize and post all of your adjusting entries, then what we're going to do problem, we have closing revenue, right? That's the first thing we do. All of our income statement accounts need to be closed. At the very top of that income statement, we have sales, and that sales account has a normal credit balance, but we want it to be 0 because we want to zero it out, put it in now. Closing entries on expenses, it's your second entry. Close all your expenses. So everything, including tax expense, needs to be closed out. A quick check I like to do is that your sales minus your sum of your expenses, this should equal net income, because what you're doing is you're closing out all your expense accounts, and you've already closed out all your revenue accounts, and so you should have well, I guess it should be these income summary accounts, right? In case you have 2 revenue accounts. But those 2 need to equal net income because that's what you're trying to do. You're trying to close net income into retained earnings. Credit retained earnings, retain your earnings, and keep them on your balance sheet. And then you close all the expense accounts, right? Normal debit balance to close them. You'll credit them, take them to 0. So next earnings. Get all these posted in the ledger. The last entry is to close dividends declared. It reduces equity. We put it into retained earnings, and a debit to retained earnings would reduce it. Ending retained earnings then should equal your balance sheet, the amount that you have on your balance sheet. So all that should be tied out. Once you get all those journalized and posted, then we can work on our post-closing. So post-closing, of course, means after the closing process. So once we do the closing process, we have post-closing trial balance. It's a list of all your accounts that you have, and it's the balances in those accounts after closing. So you would expect all of your income statement accounts to be 0. Dividends declared needs to be 0.
where you get these numbers is these numbers get pulled from your ledger. So after you finish the closing entries, then you look at all the ledgers the ending balance in those ledgers, you put them in your post-closing, you do a sum, and you are ready to start next year. All right, that gets us through the project primarily. You do have the AR subledger and AP subledger reconciliation, so make sure you get that list of all your customers and their balances, making sure it agrees out. And that's year one.
The purpose of this video is to walk through how to create a statement of cash flows for your year one financial statement project. So we should start, everyone should have a balancing balance sheet before we begin. And I'm going to build a statement of cash flows on the next tab. And I've already started working on adding my title and some key sections here in the cash flow statement. So let's walk through these sections of a cash flow. There are three sections: the operating, investing, and financing. The operating section is going to start with net income, and underneath it, we are going to adjust net income for the change in current asset and current liability accounts to convert net income to a cash number. And that is going to be our total operating cash flows. We're looking for the cash received or paid based on our income statement items. The second section is an investing section. The investing section is typically your long-term assets or your any investments, short-term or long-term investments. Now, we do not have any long-term assets or investments on our balance sheet. You can see all of our assets are current assets for the year one project. So there is no investing cash flows. So for our purposes, that is going to be zero in year one. Financing cash flows, this is all of your equity. So we will have where you issue common stock, you will get cash for that issuance. The entry to issue stock is debit cash, credit common stock. That creates cash inflows for your business. You could also have debt issuance in financing where you debit cash, credit notes payable, right? Where you have a loan and you have a liability, but you also received the cash for that. And so that's a financing, a way your business is financed. You can be financed through equity or debt. Where do you get your cash to run your business? You could get it from operations, but certainly a big component of cash flow is to issue stock and get cash or issue debt and get cash. So this is our equity and long-term debt section. The other item that's pretty unique in financing is dividends. And they're a financing item because it is how we pay our shareholders. Our shareholders acquire stock in our business, they're owners, and a part of that is where we will pay them a portion of our earnings as a business. And that's our dividends paid to our shareholders. And that's a part of the financing section of your organization and of your cash flow. Okay, so those three sections, that's a quick overview of operating, investing, and financing. And then we will talk about this little reconciliation here at the end. Okay, let's get into how to build your statement. So here's our balance sheet. I'm gonna actually duplicate this balance sheet such that I can have a kind of a scratch paper of a balance sheet. So I'm gonna right click on the tab and hit move or copy. And I'm gonna create a copy. It's really important to click this create a copy. And I'm gonna create it to this same workbook and click OK. And what that's done is it's
taken that worksheet, duplicated it. It's going to say balance sheet 2. And again, it's an identical version of the balance sheet, but I'm going to rename this for my purposes, and I'm going to call it Statement of Cash Flows Worksheet. And that's just going to help me keep my balance sheet nice and clean for its final presentation, and then I'm going to have a worksheet that I can work with, okay? So I'm working on this Statement of Cash Flows Worksheet, and the goal of the cash flow statement is to talk through how much cash you received and paid in year 1 of your business. So we're looking at 1 year of cash in and out. How we do that, I'm going to create a column here, create a new column. And I want us to realize that this is the first year of our business. So the beginning balance of our organization had 0 cash to start. And then this is the ending balance, right? Hopefully stating some obvious here, but we had a beginning balance of 0 in cash, and then we had ins and outs in cash, and we came with an ending balance of $145,879. So as you can see, we grew our cash balance. If I take the difference between where we started and where we ended, our cash grew by my cash by $145,879. For all of these accounts, they all have a beginning balance of 0. So I'm going to say that here in my example scratch paper on my worksheet. Each of these accounts started with a beginning balance, and then here's our ending balance. When you move into the second year of this project, these ending balances will become the beginning balances in year 2. So next year, you are going to have activity here in the beginning balance, and it will be equal to the ending balance. And there will be a different, each account will have changes up or down depending on what happened that year. But our whole point of the cash flow statement, our goal is to prove this change in cash. How did we go from 0 to the ending balance? And we're going to do that through the 3 sections: operating, investing, and financing. Where did we get our money? So the first section of the cash flow is the operating section. And the operating section includes everything that hits net income and changes in current assets and current liabilities. So here's a quick overview. I like to first identify which accounts go in which section of the cash flow. So all of my current assets, so let's highlight my current assets here, and current liabilities typically go in, here's my current liabilities, typically go in operating. There is one exception. The one exception is that dividends payable does not go in operating. It goes in financing, as we talked about earlier, as a way that dividends are a way that we pay our shareholders. And our shareholders, we are financed through equity. And that is a part of the financing section of our cash flow. So the yellow highlights are activity that is going to relate to operating, and the blue highlights go in the financing section of the cash flows. Okay, the other kind of shortcut and overview that I want to remind ourselves with are our directions. So if you have an asset account and it goes up, the rule of thumb here is that we subtract that amount from net income. Subtract from net income. If an asset goes down, we are going to add the change to net income. So there's an inverse relationship between the change in assets and how it impacts net income. Because remember, in the indirect method, we start with net income, and we're going to adjust net income to a cash number based on the fluctuations in accounts that impact net income. For liabilities, let me go over here. For liabilities, if liabilities go up, we're going to add. If liabilities go down, we're going to subtract. So there's a direct relationship there. The same with equity. If equity goes up, we're going to add. And if equity goes down, we will subtract. Now these are we can see it a little bit clearer with equity because the entry to get common stock, right, is a debit to cash and a credit common stock. And that makes equity go up. And we're going to add that amount as a cash inflow, right? Cash went up. And so if equity goes up, we can say therefore that cash goes up. And that's same with, common stock and additional paid-in capital going up as well. So we can see some directions here. Now let's apply that into our statement of cash flows. So I'm going to duplicate my window. And so I have this little shortcut key that says new window. You can also go to view new window. And what that does is it duplicates the workbook. And then I'm going to hit arrange and do a vertical arrangement. Another shortcut, a keyboard shortcut for the arrangement is if you have a Windows computer and you select the Windows key and then the right arrow, holding those two down at the same time and letting go, it will take the windows that you have open and arrange them side by side like this. Okay, so I'm going to start on my cash flow worksheet. I want my cash flow worksheet here, and I want my cash flow over on this side. So statement of cash flows and my worksheet. So let's start building out our statement of cash flows. So on the first line on my statement of cash flows says net income under the operating section. So for year one, my net income, and I'm going to be doing a lot of cell referencing, is I'm going to equal my net income on my income statement. And now we're going to adjust that net income for the changes in the current asset and current liability accounts. So we need to now, on our worksheet, adjust for the changes. So here's my cash flow worksheet. Beginning balance, ending balance. Here's the change in those accounts. And for year one, my change is, the difference between beginning and ending, which is ending in this case. And for this asset section, I can see that the asset went from 0, accounts receivable is an asset, it went from 0 to 65,410. So that means it went up. And if an asset goes up, the rule is that we subtract the change. Okay, so there is our asset goes up. See if we can see all of these together. Asset goes up, we subtract the change. All of these assets actually went up, so all of the changes are going to be subtracted. Pulled that formula down. So then I'm going to look at my change in AR and select the change with the correct direction. I'm going to change my formatting here so that there is no $sign, but just at the top. And shop supplies also subtracted. Office supplies also subtracted. Prepaid insurance went up. Direction is to go down. Lumber inventory went up. Therefore, we subtract. If an asset goes up, we subtract. If a liability goes up, we add. And so the two liabilities that impact operating are accounts payable and taxes payable. So I'm going to add those changes here. There's a direct relationship. If a liability goes up, you add. Now remember, next year you might have some going up and some going down. So be very careful how that works out. Total operating cash flows is a formula where it's going to be equal the sum of all of the activity above it, where you take net income and adjust it for all the changes. So this is telling us that while we showed a net income of $86,400, the actual cash that we received from those transactions of sales and those transactions of expenses and payments to our suppliers, we actually had operating cash of only $28,179. So that just kind of means that we still have some people that owe us money from sales, and perhaps we've already been paying a lot of our accounts payable off because that cash is pretty low relative to net income. Investing is 0. We have no long-term assets and or short-term investments to deal with this year. Financing cash flows. So as I mentioned, if equity, so these accounts here in blue are our equity financing items. We could also have long-term debt, but we don't have long-term debt in this problem either. So we just have the change again. So to remind us, if the equity account goes up or common stock and additional paid-in capital go up, that's an inflow to cash. That means cash is going up. As you can see in this entry over here, debit cash, cash went up, equity went up. So the issuance of common stock gave us cash for those two things added together. So I selected common stock, the change in common stock plus the change in additional paid-in capital. Make sure you're using the change in. And that gets us the cash we received from issuance of stock. Now, dividends paid is a little bit trickier because dividends payable is an account, but is not always what we paid in cash. And so I'm going to come over here and do a dividends, cash paid for dividends reconciliation here. So I'm going to create a T account for the dividends payable account. And in my T account, I am going to talk about the activity that is in this account. So we started dividends payable. This is a balance sheet liability account, and it started at 0 this year. But remember, next year, the ending balance is going to be the beginning balance next year. So if I go to my dividends payable, I currently see it started at 0 and now it's at 3240. Well, my beginning balance next year will be 3240 and then they'll have an ending balance. So just realize that this year our dividends payable starts at 0 and it ends, I'm going to show the ending balance here, and it ends at the ending balance on the balance sheet. What is the activity in this account and why does this matter for cash paid for dividends? Cash paid for dividends is impacted by this dividends payable account, but also it's impacted by the dividends declared account. So we have to factor in the dividends declared amount. Now, the dividends declared amount, if you remember at the very beginning of this project, we debited dividends declared and we credited dividends payable, this account, for the amount of the declared dividend. And so all of the declared dividends going to say we will pay this declared dividend, but then we have to figure out what we actually paid. And so we're really looking for the cash paid for the dividends, which is seen as a debit to the dividends payable account, right? Because the entry to pay a dividend would be debit dividends payable and credit cash. And we are looking for this cash paid number, which is seen in the debit to the dividend payable account. So we have to find this number that's sitting in the debit to dividends payable because we know that the other side of that entry is the cash paid. And the whole point of the cash flow statement is to look for the cash. We need to find the cash paid amount. So to do that, we need to find our dividends declared number. So I'm going to go to my statement of equity because I know it's a part of equity. And I'm going to come down here and I'm going to look at dividends declared. And that's my total credit of what we will pay our shareholders. We don't know what we've paid or haven't paid them yet. So on my cash flow worksheet, I'm going to hit equals and I'm going to do a negative sign because I want it to show up as positive right here. So that's my total dividends declared from, I got this from the statement of equity. The cash paid number, if we think about how a T account works, here's my quick T account explanation. The beginning balance plus the transfers in is going to equal the ending balance plus the transfers out of that account. So to get this amount right here, this is the transfers out in this case, I'm going to have to take the beginning balance plus the transfers in, and then to do a little bit of algebra, I'm going to move that ending balance over to the other side of the equation by subtracting it. I have to subtract the ending balance. And that's going to equal the transfers out in the account if I think about how a T account works. And so the entry for the cash paid for dividends is going to be the credit cash paid of 2,300, which is therefore the debit in that dividends payable account, such that my T account all balances. And you can see it's really these difference between the dividends declared and the ending balance. That's what we have left. This dividends payable is what we have left to pay, right? So we already paid 2,300. Another shorter way to do this, as the math works, is to look at your negative dividends declared. This is kind of a short math way. Negative dividends declared, and you're going to add to that the change in dividends payable. Dividends payable. Now, it's a little tricky here because our change in dividends payable is positive, but it could be negative. So here, let me show you what I mean. I want to take a negative dividends declared. So here's a shorter mathematical way of solving cash paid for dividends. And this will equal, our goal is cash paid for dividends on the cash flow statement. The change in the payable. Now, the change in the payable can come from here, right? It went up this year by 3240, and we're going to keep that sign 3240. Now, it could have gone down. If dividends payable went down, you would put this as a negative number. Cash paid for dividends then is going to be the negative dividends declared plus the change in dividends payable, keeping whatever sign is there in your change. And you will see that the cash paid for dividends is the negative 2,300. So either way works. You can look at the T account to find cash, or you could do it in more of a mathematical format where we said, okay, total dividends declared plus the change in the payable, and what's left is what we've paid. But going to your statement of cash flows, dividends paid will equal a negative 2,300. Or you could say perhaps equals 2,300 cash paid. Total financing cash flows will be the sum of those two items that we have in financing. Change in cash. How this cash flow works is the change in cash is going to equal the sum of the three sections: total operating plus total investing plus total financing. The change in cash is here. Now we can prove that change in cash out. That's the whole point, is it should be the change in cash from the beginning of the year to the end of the year. And we see that it is. It agrees. So we just show that reconciliation. Beginning cash is going to be where it started, in this case 0. And ending cash we show as a formula as beginning cash plus the change in cash. And that should equal ending cash, and it does. And that's how we know we did the cash flow correctly. Ending cash here must equal ending cash on our balance sheet. And we've proved out the change in cash. In our problem, we had $28,179 from operations, and we can see we had a lot of cash from our financing of issuing stock. All right, that is the statement of cash flows.